Shift gears then straight up to quarterly earnings. Shyam Srinivasan is the Managing Director and CEO of Federal Bank here to talk about their quarterly performance. Thank you so much for joining in. To begin with, can you just give us a brief overview of the third quarter? Do you think that will you describe it as a strong or a weak performance? What have been some of the key parameters in Q3?
Quarter that went by was good in the sense that it was a stressful environment, and I believe that our outcomes have been quite encouraging. In particular, other than the two names that we had signaled, the large ticket credits, we were keen that the overall portfolio continues to perform well. The slippages are lower. Very happy that retail, SME, agri all turned out their multi-quarter best. So on balance, given the external situation, our performance for Q3 on most counts was something that we take heart from.
Mr. Srinivas, there has been a slowdown as well in loan growth in the quarter. What are the factors that have led to this, and how much of a role did corporate play? How does this quarter change the year-end target and change the guidance for Federal Bank for the year?
So the growth for Q3 was mixed, as in the businesses that we are working hard on in ensuring growth, as in retail, agri, gold loan, commercial banking, all saw almost sequentially a 20% plus run rate. Gold in particular, or retail in particular, was 25% plus. The corporate business, which is a 50% or 40% of our book, saw significant repayments. We took some technical write-offs, and a large restructured account got fully paid. So the blended outcome was modest growth. So the 13% outcome is to be seen in the by deconstructing the portfolio. Our full year credit growth, originally we had visualized between an 18 and 20. Now it looks more like a 16-17% full year credit growth, which will still be about 600-700 basis points higher than the market growth, and positions us well for FY21.
All right. So Shyam, within the bank, how have the various segments performed? Where is the mix between retail and wholesale, and how has that changed?
No, I think if you remember, the book of the bank between retail and wholesale, at one stage wholesale about 53, retail 47. Our target was in 4 to 5 quarters to make it 50-50 between retail and wholesale. Here I clarify, retail is all exposures below 5 crores, whether it's individuals or small businesses. I am happy that at this point in time, it's come down to 51-49, which is wholesale 51, retail 49. Effectively because the rate of growth on the retail business, like I pointed out, is in some cases 25-26%. And that momentum will take us closer to our 50-50 objective by Q4 end or Q1 of next financial year. And I think we would like to grow on that base, both businesses effectively ensuring the growth. In retail, it's many segments, whether it's the traditional home loan or auto loan, or businesses like gold loan, which is tracking well, and some of our new initiatives around existing customers data mined for personal loans is doing well. We are also seeing some traction on the newer businesses like commercial vehicles that we've kicked off, but those are on very small base. So going into FY21, those should start accelerating. As the environment picks up, it will give us some fillip there.
Barring the already flagged HFC accounts, what is your standpoint on slippages and asset quality in the remaining book?
No, I think our run rate on slippages disaggregated by the different businesses, like I mentioned, retail, SME, business banking are trending well. In particular, this quarter was a multi-quarter low. We don't see that dramatically changing. If anything, it should improve for the better. Corporate has been choppy because these two names that we had, the industry is familiar with, the two large housing finance companies which have run into a problem. So we've taken the appropriate hit on that. I'm hoping that with that going away, we don't have any more large names to particularly deal with, other than the provisioning for the accounts that have already been tagged as NPA. We'll have to see how they are shaping up, the resolution process is shaping up. Based on that, the NPA provisioning will happen across the coming quarters. But we made more than minimum requirement in some of these instances already.
So where do you see your provision coverage ratio normalizing, including the technical write-off? What will it be?
No, our provisioning, like I mentioned, has improved as a overall based on the technical write-off accounts also, because we did make some significant technical write-off this quarter after providing 100% on those accounts. So our provision coverage, including technical write-off, is now closer to 67% and improving.
So what cues are you drawing from the results of HDFC, Kotak reporting the rising NPA growth and seeing a lowering growth overall? What does this mean for the rest of the sector in your assessment?
Here I'd like to be a little more direct and say, yes, they are extremely good banks, but we are no less, and we have taken some conservative decisions for the last 12-18 quarters, and that will give us good momentum even through relatively bad cycles. So, and a large part of our book is very well secured. So I am not alarmed if the environment doesn't deteriorate, and which is what our focus is. Our momentum, our performance on credit should hold well. Our asset quality is quite stable. Our stressed asset book is at an all-time low of 1.59%, and we believe that our credit costs and our overall slippages are probably top quartile right now.
Let's talk about the larger threats looming out there. Telecom would potentially be a major sore point. Do you have any exposure to that at all? I mean, are you worried about Vodafone going belly up?
No, firstly, from our point of view, we have no exposure to any of these large telcos that you're referring to. So thankfully, we are not in that worry list. Now, whether that systemically will there be a problem if they either don't honor or they defer or delay, there could be consequences, but I'm sure there is a certain degree of effort to make sure that that's well addressed. But at this juncture, very selfishly speaking, we are not impacted by the developments in that space. What happens to the wider system needs to be dealt with. We are hopeful that some saner voices will prevail and this will get sorted out, at least better addressed.
Given the current growth plans and the rate of capital consumption, are you sufficiently capitalized, or there would be a need to raise capital very soon?
We did our last raise in June 17, and typically we look at about 3.5 years of growth being funded. At this juncture, our capital adequacy is well north of 13. This is before plowing back profits. So I think the next raise for us should come end 20 or early 21, depending on how the environment is and how our growth shapes up. As of now, we are very well capitalized, and all of it is tier 1. So we don't visualize something in the near 2-3 quarters.
Fair enough. Thank you so much, Mr. Srinivas, for joining in and sharing with us the outlook on your quarterly earnings as well as your asset quality, slippages, and your performance going forward. That's a